You're listening to CFRN, a community of believers who trade for a living. To learn more about who we are, what we do, and how we do it, call toll-free 1-866-928-3310, and we'll send you out a no-obligation information kit absolutely free. 866-928-3310. The CFRN Emini Futures Cast is now on Stitcher. Listen to us on your iPhone, Android phones, BlackBerry, and WebOS phones. Stitcher is smart radio for your phone. Find it in your app store or at Stitcher.com. Stitcher Smart Radio, the smarter way to listen to radio.
Are you ready, Steve? Andy? Yeah! Bert? Well, all right, fellas. Let's go!
You're listening to CFRN, the Christian Financial Radio Network.
Today's broadcast is brought to you by Audible. Get a free audiobook download at www.audibletrial.com/CFRN. Over 85,000 titles. Choose from mystery, romance, religion, science, technology, business, New York Times bestsellers, even children's books. You name it, Audible has it. With 85,000 titles to choose from, you're sure to find the perfect audiobook for yourself or to give as a gift, and it's absolutely free. Just point your browser to audibletrial.com/CFRN. That's audibletrial.com/CFRN. And become a part of the audiobook revolution by downloading your free audiobook today. audibletrial.com/CFRN.
Hey, trader, want to get rich quick? Well, good luck with that. If, on the other hand, you actually want to learn how to trade, the place to be is www.cfrn.net. Tune in Monday through Friday, 9 a.m. Eastern for our daily devotional, and then spend the next 3 hours learning how it's done for professional traders who actually trade for a living. That's www.cfrn.net. Every trading day from 9 a.m. to 1 p.m. Eastern. CFRN, a community of believers who trade for a living.
Good afternoon, traders, and welcome back to the CFRN Emini Futures Cast. This is the daily broadcast of Indeterminate Length, where we discuss all things Emini, along with some really big ideas on the finer points of trading gold, bonds, crude, sugar, the euro, and even T-bills. Joining us today from our studios in Boston, Mr. Michael Borth. From our trading desk in Chicago, Mr. Burton Schlichter. Now, to get things started, let's go to our host and founder in Studio A, overlooking South Mountain, America's largest city park. Here's Dwayne.
Good afternoon. Welcome back. Today is Thursday, 31st day of October, 2019. Thanks so much for tuning in. Whoever you are, wherever you are, we're just glad to have you right here, right now. Let me put up a chart of the S&P 500 Emini Futures. We'll make it a daily chart. There we go. If you can't see the chart, go to our homepage at CFRN.net. On the right-hand side of the page, click the big microphone, follow the instructions. You'll be registered in about 30 seconds, and that'll give you one-click access to the show each and every day. On the days you're out of the office, away from the desktop, not to worry, point any internet-connected browser to youtube.com/CFRN/live. There you will find a live, real-time simulcast of the show as it unfolds, brought to you by the good folks at YouTube. Thanks, YouTube. Okay, we covered this in depth yesterday, so we'll just pass over it today. All-time historic high led to a pretty decent sell-off. The next all-time historic high led to an even bigger sell-off. Next all-time high, yeah, you're catching the theme of this. Next all-time high, there and there, both led to a sell-off. And so we now have a new all-time historic high in the S&P 500 Emini Futures. Question is what will the coming days and weeks bring us? Now from this swing low to the new all-time historic high, the shallowest Fibonacci retracement would be the 24% fib right here, which lines up with the most recent swing low on the daily chart. If that doesn't hold, then we're looking at the 38% Fibonacci retracement, which lines up with the swing low right here that was put in on August the 6th. If we apply our indicators, and our indicators are fluid across all markets, all time frames, so the shallowest retracement would be back to the BBC, which is about 29.98 right now, 29.95, 96. Again, the number below that, 28.83, and then below that, 27.70. Now that's in if the market does what it's done, what it has done in the past, we'll be looking at one of those numbers. Could the market do something different? Absolutely. The market can do anything it wants, and whatever it does, well, it's always right. Now you can see the price always reverts to the mean, and in our case the mean is the green line, the BBC. You got to name, you got to give stuff a name, and so that stands for bull bear cross. When price crosses above, we expect higher prices. When price crosses below, we expect lower prices. Above, higher prices. Below, lower prices. Above and below, above and below. Currently, we're above. So we have to anticipate higher prices until we revert to the mean. And as long as we stay above it, we'll continue to anticipate higher prices. The first indication we'll have that price is headed to one of these Fibonacci support levels, such as the 24% fib, would be a daily close below the BBC, and then some follow through, which could take a couple days, a week. Often the market will move to the downside a lot faster than it moves to the upside. I think they call that gravity. All right, got a little bit of news. 11 years ago today, nobody had ever heard of Satoshi Nakamoto. Now, a segment of the population has heard. Satoshi, whether it be a person or a group of people, we still don't know 11 years later. Satoshi published a white paper entitled Bitcoin, a peer-to-peer electronic hash system. This was October 31st, 2008. It outlined a tamper-proof, decentralized peer-to-peer protocol that could track and verify digital transactions, prevent double spending, and generate a transparent record for anyone to inspect in almost real time. The protocol represented a cryptographically secured system based on a proof-of-work algorithm in which bitcoins are mined for a reward by individual nodes and then verified by other nodes in a decentralized network. This system contained the possibility of overcoming the need for intermediaries such as banks and financial institutions to facilitate and audit transactions, a major disruption to a siloed, monopolized field of centralized financial power. 11 years later, Bitcoin is consistently setting new records for its network hash rate, a measure of the overall computing power involved in validating transactions on the blockchain at any given time. More power and participation establishes greater network security and attests to widespread recognition of the profitability of Bitcoin mining. As of the middle of this month, network data revealed that since the creation of the very first block on the Bitcoin blockchain, January 3rd, 2009, known in more technical language as its Genesis block, miners have received combined revenue of just under $15 billion, and that's B as in billion. The figure includes both block rewards, new Bitcoins paid to miners for validating a block of transactions, as well as transaction fees, which broke the $1 billion mark this week. Bitcoin's first ever recorded trading price was noted on March 17th of 2010 on the now defunct trading platform bitcoinmarket.com at a value of 0.003. Not 0.03, that would be 3 cents. No, 0.003. The cryptocurrency's appreciation thus stands at a staggering, I can't even read the number. Write it down. 304,033,233. What is that? 304,332,000% as of press time, with Bitcoin currently trading around $9,000. As of this August, 85% of Bitcoin's supply in circulation had been mined, leaving just 3.15 million new coins for the future. 11 years on, the mystery enshrouding the white paper's author remains as impenetrable as ever. Those both within and without the crypto community began attempting to determine Nakamoto's identity as early as October 2011, just a few months after the mysterious figure first went silent. There you have it. A historical day in the crypto world. Let's take a look at the numbers from around the world. Start here in the US. These are the cash markets. Currently, the Dow is down 205 points. NASDAQ down 32. S&P 500 down 17. And the Russell 2000 down 14. In the commodity basket, crude oil down 94 cents, trading 54.12 last. That's a drop of 1.75%. Gold up $16, trading 15.1270 last, a gain of a little over 1%. In the Asian markets at the close, Nikkei posted a gain of 83 points, Shanghai lost 10, and the Hang Seng added 239. And for the Hang Seng, that's a gain of almost 1%. In the European markets at the close, FTSE down 74, 1%. DAX down 20, and the CAC also down 20. That gives us a mixed day in Asia, red day in the UK, and so far it is a big red Radio Thursday here in the US of A. Let's go to Michael and get a recap of everything that happened in the live training room this morning. Michael, if you're ready, take it away.
Okay, I am ready. Excuse me. Bring it over here. There you go.
Alrighty, it's all yours.
Excellent. Okay. Let's start off with. No, not that page. Start off with this page. Okay. If you have not taken a free trial with us, go to the home page at CFRN.net. In the right-hand column, it says 5-day free trial. Apply.CFRN.net. Oh, sorry. I forgot to say good afternoon. Happy Halloween, everybody. It is Thursday, the 31st day of October, 2019. Okay. Go to the home page at CFRN.net. You click on this right here, 5-day free trial, and you'll be brought to this page where all we ask for is your name, your email, and your phone number. Hit the register now button and you'll be sent a confirmation link. once you click the confirmation link, then we know you took the free trial. So you got to make sure you click that box. Okay. Check your email. Make sure it's a good email, a valid email, because you won't get a confirmation link. If you don't get the confirmation link after you've done this, then you need to check your spam folders and whatever other kind of folder that mail goes into. Okay. Now, the spreadsheet. We had a red day today. It was a red day. We had 7 trades, and today was red. We lost 8 ticks in crude, minus $80 after 7 trades. So we're going to end the month plus 2,355. That's over 22 days, averaging $107 a day. On the year, now we're at 30,786. That's over 197 days, averaging 156 per day. Okay. Now I know that doesn't seem like a big number. That's one contract, 2 hours per day. And what we want you to do is build up the number of contracts. You know, as you earn the right to trade more contracts, then you can add contracts on. Now, this number is one contract, but if you added one contract per month, you'd be at 189,678. And that's me missing most of the trades. You know, that's if you did everything exactly as I did. But that's me missing a lot of the trades, probably half of the trades, I'll say I miss. And the half that I miss are usually winning trades. And that's 2 hours a day. Okay. So you should be doing much better than that. All right. Minimize that. Come over here and look at gold and show you what little we did there. We had 3 break-even trades in gold. First one was right here. Break even, and then it went up and did what it should have done. The next one was right here. It's break even, and then it went up and did what it should have done. And the next one was right here. Break even, and then it didn't do what it should have done. I was glad to get out of that one at break even. During the break, there was a shorting opportunity right here. A nice shorting opportunity right there. Looks like that was the second one right there. Then it flipped around and it gave a long opportunity right here. Okay, so during the break, there were some pretty good trades that could have been taken. Again, that goes back to my 2 hour a day thing. The euro, once again, had nothing. Oh, this isn't the euro, this is the Russell. Sorry, I flipped the euro out and put the Russell in. The Russell did have stuff, but I didn't do it until halfway through the session, so I didn't highlight anything. We can go through it though. Let's see. I'm just looking at the slingshot to see. Right here was a shorting opportunity. Right here was a long opportunity. Right here was a shorting opportunity. A short, a short, a short. And the cycle started going up on us. Then all the way over here, the cycle would reset. A short there, that big leg down. Then it tried to change directions, and there was a long right here. Didn't go too far. This is when we started looking at it, right here, halfway through the session. I was drawing trend lines, but I hadn't had my DOM open yet, so I wasn't taking any trades. There was a short, it would have been right here. Okay, and then we get into the break. And it looks like during the break, there was a short off the BBC right there, and a follow-up short right there. Then another one right there. And one more right there. And that was the Russell. Now, crude oil. We had 2 break-even trades, one there and one there. And then, it was going into the low of the day here. That's why I wasn't doing anything with it. It got all the way down to 53.70. Wow. So options be cheap right now. The 56 options would be cheap. Anyway, we stopped out on that one. We had 2 break evens and a stop out. And that was it. During the break, there was a long right there. Would have worked out really well. Another long right there. That would have worked out. And then it got choppy. And that's it. On the ES, what did we do on the ES? We had just that one break-even trade on the ES. Now the ES was going down really nicely, but it just wasn't giving us any trade setups down here. Okay, not until it started to go back up. And then we had a trade setup right here. We ended up with a break-even on it. And then we get into the break, and it looks like it was really choppy during the break without any trade setups. And that was it. That was our morning. So it was rough trading today. The trades that I missed would have made up the difference from this, from my -8 ticks. But all right. So again, if you're going to read the spreadsheet, you can read all the CFTC risk disclosures down at the bottom. Today's the 31st day of October. It's Halloween. We're -8 ticks on crude oil. All right, that's -$80. We did not get the goal for the day, and we took a total of 7 trades. So on the month, we're plus $2,355. That's over 22 days, averaging $107 per day. On the year, we're at $30,786. That's over 197 days, averaging $156 per day. Okay. Yeah, I got to go back to that other one. If you have not taken a free trial, go to the homepage at CFRN.net. In the right-hand column, it says 5-day free trial, apply.CFRN.net. If you click on that, you will be brought to this page, eminitrainingschool.com. On this page, all we ask for is your name, your email, and your phone number. Hit the register now button, and you'll be sent a confirmation link. You must click on the confirmation link. Okay, if you don't click the confirmation link, we don't know that you took a free trial. So you got to do that. All right. All right. And with that, we can send it back out to fabulous Phoenix, Arizona. And Studio A, overlooking the nation's largest city park. Dwayne, if you are ready.
I'm ready. There we go.
Okay. There it is.
Okay, recap of the recap.
We had a red day today. We were down 8 ticks on crude.
That's the truth about trading.
It is.
So, folks, whether it's an up day or down day, it's just another day. And so, we tell you about it. We don't sweep it under the carpet. If you keep sweeping stuff under the carpet, eventually you're going to trip over it and somebody's going to get hurt. So, best not to do that. And that's how we've done it every day since the beginning. So, the truth about trading. So, I stumbled across a new thing, and I want to show it to everybody here. It's kind of neat. I'm almost surprised I haven't heard of it before, but I actually found out about it in a roundabout kind of way. I got some, I think it was an ad on Facebook or something, and so I went to the webinar, and this guy was pitching this whole deal, but at the end of the day, I found out it's really, you don't need the guy or the webinar or anything else. You know what NFC is? NFC.
NFC.
It is near field communication. You know how some credit cards you can just like wave them at the little terminal and it locks and loads. Okay. It's because it's got this little NFC chip embedded in the credit card or debit card, whatever you're using. And when it gets in proximity to the terminal, it's sending out a signal and it gets it. So there are things called NFC business cards. What this does, and let me find that one on Amazon that I was just looking at. I wanted the Amazon because I'm familiar with that page. Let me just type in Amazon. So you can get them blank like this, and no, that's Amazon. Let's go straight to the chip. Now what happens is you program this chip to perform some kind of function. And with business cards, typically what people use it for is to just do something really simple, because there's not a lot of storage space, so you can't give it, you know, a complex set of instructions. But if I hand you a business card and say, hey, when you have a chance, tap that card on your phone. Well, they take the card, and everybody will do it because it's such a novelty kind of a thing. You tap the card, the business card, on your phone, Android or iPhone, and it, in most cases, if this is what you've told it to do, it just opens a web browser and takes you to a dedicated page where, let's say you're a musician, you've uploaded some of your tracks, some of your musical tracks, or you've uploaded a video. So let's say you're a musician and you're out going from bar to bar, you know, trying to find a gig someplace you can play. And of course, you're going to always give the bar owner or manager a business card. But with this, it just takes the whole business card a step further, because it comes alive. And it works over and over and over. I don't know if there's a shelf life on them or not. And you can do all kinds of different things. You can get all kinds of different tags. That's kind of what it looks like. Let me go back to the actual cards. Here's some blank ones. So you get, in this package here, you get 25 cards. Now the guy with the webinar, who had a whole kind of pitch built around this thing, I think his were $4 a piece. So that's for the business card, printed like an ordinary business card, but it also has the tag, the NFC chip. I guess that's about as good as you can see them. Do you see the significance of that? You see how it could make, you know, whatever business you have. Musicians is the one that the guy in the webinar was pitching specifically to musicians, but any type of business where you want people to go to a website and look at something. And what's neat is once you give them the business card, you could tell them, if you want to, tap that every Monday or every Sunday, because you can go to the web page that you've told it to magically load when the card is tapped on the phone. And let's say you're a musician, and so you put up, maybe you put up a new song every Monday. So a person gets in the habit of like listening to your new song every Monday, or whatever it is that you sell, whatever it is that you offer. Maybe you're some kind of a wholesaler and you sell widgets, and every Monday you launch this week's widget sale. So the person who buys the widgets, they know that every Monday, if they just tap your business card on their phone, they'll get the most updated pricing and sales, whatever it is that you're offering this week. Isn't that cool?
That is cool.
Now, the guy in the webinar, he wanted $4 a piece for them, and I thought even at that price, well, $4, I think for the right person and the right business model, I think this would be very, very cool. But you get them 25. I thought of these $14.99. Includes 25 glossy finish laminated white PVC cards. They got some metal ones that are pretty neat. Waterproof PVC material of the badge protects the NFC chip inside. You can only put 888 usable bytes of data. So if you wanted to just upload your contact information, name, address, phone number, etc., to a person's contact list on their phone, you can give it those instructions. Or you could tell it to open a web browser, but there's not enough storage space on the chip to do both. So you got to decide which one you want to do. And they've got metal ones. Back up here. NFC business cards. And if somebody hands you a metal business card, you're really going to remember that. You're probably going to feel guilty about throwing it away. So, Moo's always expensive with everything. NFC business card. Here's a metal one. Now that's $200. I wonder how many you get for $200. You get 100. Okay, so you're paying basically $2 here. But these are professionally designed metal business cards for $199. These cards are for people that want to make an instant impression. You'll be noticed and people will ask you about these cards. The unique all-in-one package makes buying and designing metal business cards easy. Simply purchase this pack and let us take it from there. Okay, so this includes the printing, the design, whereas the ones we looked at a moment ago, where you get 25 for $15 or something, that's just the blank with the chip in it. Simply purchase this pack, let us take it from there. Our professional designers will come up with a card design that matches your style, and we won't take your cards to production until you're 100% happy with the design. We want you to love it. 100 stainless steel business cards, free artwork, free custom shape, free cut-through area. Yeah, I thought that's what I saw. See how that's cut out right there?
Mm-hmm.
Yeah, so that's another cool factor. Free one-color ink, free shipping in the U.S. Fantastic product, outstanding. Yeah, I'm just I'm smitten. I think it's. I don't have a use for this, but I've already sent the information over to a couple of my musician friends from church, because they're in the praise and worship team at church, but they also do, gigs to pay the rent in local restaurants and bars, happy hours, and so forth. But I just want to, and this has been around, I guess, for a while. I'm surprised they aren't more popular. I'm surprised I haven't. Oh, look at that. This is a photographer. Looks like a camera, and they just cut the middle right out.
Shaped like a camera.
Smoking Joe's gift card. So I just stumbled onto this, I think, day before yesterday, so I haven't had a chance to really research it. I'm curious what other things you could tell it to do besides upload your contact information to their phone or open a web browser. There's probably some other clever thing you can do, but again, that one we looked at only had 888 bytes, not megabytes, but just bytes.
Yeah. That's like one line of code.
Pretty neat. Moo, I like them. I had some, they gave me, I won some kind of thing, I don't know, and they gave me like 50 cards, but they're just plain old cards. They're pretty expensive. That's gold foil. It doesn't look like the. Do one more look here. Now, I saw some that you can print on a laser printer, and I've seen those print at home business cards before. I mean, back in the 90s, we used to print our own. They never come out looking, quite like you want them to. But you can, oh, I saw NFC shot glass. Not sure what you do with these. NFC shot glass. So I guess you tap your shot glass on the phone and it does the same thing. NFC shot glass. Whether you're celebrating Cinco de Mayo with an amigo or searching, you can buy a set of shot glasses. Now, these don't look like NFC though. It says they are. Back up. And these little tags, you can put them on anything. I mean, you could put them on, obviously, a shot glass, or put them on a business card. I think that's the most popular application. SmartTrack's Glass Tag NFC is designed for a broad range of applications: retail, apparel, toys, games. The Glass Tag NFC is available with either a chip featuring up to 316 bytes of user memory, or there's this one with 888 bytes. Data from the chip inside the NFC glass tag can be read by either a dedicated reader or an NFC-enabled smartphone, and I think all Androids and all new iPhones are NFC enabled. The typical read distance ranges between 2 and 3 centimeters. You really don't have to tap it. I think you can just wave it, but it sort of makes it seem like magic when you tap it and the web browser just pops open. Because I think if you hand that business card, if you hand a business card to someone, there's a chance they may go to your website and they may not go to your website. But if you hand them one of these cards and say, hey, when you get a chance, tap that card on your phone and watch the magic, I bet you 100% of those people go to your website, go to that web page, because it's just neat, so they're going to do it. And then once they have your web page open, they might actually read it or look at it. So, pretty cool stuff. All right, just wanted to share that with the audience because I know we have folks with all kinds of businesses in all kinds of fields and industries. And so if you are trying to get people's attention, want people to remember you, you're trying to bring in new clients and all that stuff. And I like the fact that you can, it's not a one-shot deal. It's not like the information is embedded in the chip. Just the action is embedded. Because if you were selling some kind of something that had a subscription model, whether it was a newsletter or whatever it might be, once a person signs up and you give them the card, then every Monday, maybe the newsletter comes out. So every Monday they just tap and they get this week's newsletter. Pretty cool. Pretty cool. Haven't figured out what I would do with it. I don't have anything to do with it at the moment, but I love cool technology. So, okay. All right, guys. S&P 500 E-mini. Now this is the continuous chart. And let me put it on the December. The two are about the same right now. Let me blow this up a bit. Okay, now you can see it. Okay, so we can see that the high probability move, which is underway, is a pullback to the BBC. That's the shallowest retracement based on our methodology, our indicators, how we see the markets. Again, what we do is fluid across all markets, all time frames, but on the daily, I see in the wind, not a forecast, not a prophecy, just the next high probability thing based on our understanding of markets. We'll pull back to the BBC. The market will then have to make up its mind. Pullbacks to the BBC, whether you're pulling down or pulling up, holds more often than it doesn't. So when price reaches 29, 98/99, call it 3,000, the market will have to make a decision. Is it going to bounce, take us back up in an attempt to challenge this new all-time historic high, or will it fail to hold? If it fails to hold, then right here, the important price, important area where the last bullish cross took place. So there's number 1, there's number 2, and then number 3. Price would have to, in order to not do what I just said, price would have to reverse somewhere between here and the BBC for whatever reason. I mean, it could happen. It could be a tweet. It could be most anything. It would have to reverse, go back up. We know we're going to have some resistance here. It would have to deal with that. And so hopefully this is a clear picture for everyone to understand how you can determine what the next high probability move is. Once you understand our methodology, once you understand how we see the market, think about the market, and then our actions are based upon what we discern from the market. Not a guru, not some guy on TV, not some joker on the internet, but the market itself. So now, here's something you want to take under consideration and think about. You'll never see me put out an alert, a Logic 247 alert, that is counter trend. It doesn't, I'm not saying that's not a valid style of trading. Some people, they counter trend trade just as easily as they trend trade. We don't, because we're teaching new people, and even if you're not brand new, apparently you've experienced, some difficulty becoming consistently profitable in the markets, because you're still trying to find someone that can help you and show you a way and teach you something that won't let you down again. So I like to keep it simple. That's why I only do the trend. Now, in smaller time frames right now, you'll see us go long, go short, whatever the time frame in front of us presents. In the morning in the live training room, you'll see our methodology displayed and explained on the range chart. And there's a list of reasons why we use the range chart. Do you want to share that, Michael? You want to give them a quick thumbnail of why we use the range chart?
Yeah, sure. We use the range chart because if you're using range bars, like for instance, we use a 4-tick range bar. And on the ES, let's say you had a 4-tick range bar that had a low of 30.90. You know it's going to have a high of 30.91. It's going to be 4 ticks higher. Okay? All right. And, well, this is soybeans.
Yeah, I just changed it. Changed it. I got to take that tab off. But yeah, this is a 4-tick range of the S&P right here.
All right. Well, the current bar right now has a low, it looks like, of 30.22. So 30. It's going to have a high of 30.23.
Okay. Yeah, say that again. Now.
Okay.
The low's 30.22. So if this
the
thing
low is 30.22, I think it is, then it's going to have a high of 30.23. So
swing low 30.22 on the nose.
Yep. So if we were thinking about going long, you could be proactive right now. Put a buy stop on at 30.23 1/4. So when it closes up at 30.23, your order's there ready to go. It's FIFO, first in, first out. So you could have your order on ahead of other people who are waiting for the bar to close. Okay?
That's it. It gives nice symmetry.
Mm-hmm.
We don't know we don't know when a new candle is going to show up on the chart. With a 5-minute chart, you know that even if price doesn't move a tick, every 5 minutes you're going to get a new 5-minute candle. 30 minutes, same thing, daily. So we don't know when we'll get a new candle, but we know
there's no time element associated.
we know at what price. because every candle is 4 ticks tall. And for the S&P, we know that 4 ticks is 1 point. So if the lows 30, 32, is that what we said? 22.
30, 22. 30, 22. It's going to have a high of 30, 23.
Yeah, exactly. Exactly.
And if the high is 30, 23, and you're thinking about going short, which we would have been doing here, you know the low is going to be at 30, 22. So you could have been proactive right there and had an order on it. 30, 21, 75. Yep, just like that. And
on
could have
these,
been
because
proactive.
we pulled all the way back to the BBC, down close, so the open of the next candle, minus a tick. And the reason it's minus a tick, the closing price of this candle was 24 1/4. The opening price of this candle was 24 1/4. So that can be a little confusing at first, but then once you realize, well, that's just how it is, then you quickly adapt to that. We would think that it would just kind of make logical sense that the next candle would open 1 tick different, but it doesn't. So again, we just have to accept that. On this one, we didn't pull all the way up. So in the morning in the room, you see Michael draw these trend lines, and that's the reason, because it didn't make it all the way. And that happens when there is some pretty brisk downside momentum. Now, if I slide that out of the way for a second and go to the 30-minute, we can see that on the 30-minute where I have the zones, and these are this week's zones, okay? We consolidated, well, we went from zone to zone, and then we consolidated when price reaches a weekly trading zone. The most likely thing to happen is what you see right here, consolidation. Second most likely is rejection, which is what you see right here. And the third, and least likely, but it happens, is the slice. And right here, you can see that this one candle, this 1 30-minute candle, sliced through that zone like it wasn't even there. When that happens, what we anticipate is, now because we were moving on up, we expect it to be good resistance. But instead of being good resistance, we sliced through it. So now price is pulling back to see if it will be good support. It failed to be the resistance we anticipated. So before we go getting into a trade, let's see if it's going to serve as good support. So we pulled right back to it. It did serve as good support. And so the entry would be on the next candle, and you don't have to deal with a plus or minus on a time-based chart. But that's really the only difference between what you see Michael do in the morning and what we do with the alerts, is the time frame on the chart and the amount of risk that you have to assign each trade. In the morning, we use 8 ticks, an 8-tick hard stop on every market, on every trade. That's just to keep it real simple. So that's just one thing you don't have to worry about as you're learning the methodology and learning how to read the indicators. If you decide, after you've received your training there, if you decide to move on to discretionary trading and trading in larger time frames, we then base stop loss on market structure. So we have a 3-step methodology that we teach you, where you learn to size up the chart without anybody telling you anything. You don't have to consult anyone, turn on the TV, look something up on, you just look at the chart. The chart shows you exactly where to put the stop. And if that stop is too great, if that stop loss is more than, and on Concierge and Logic, we don't want to risk more than $300 per contract per trade. If market structure dictates that we need to risk more than $300 per contract per trade, we then wait or go look at another alert. Important prices in important areas are almost always tested. So if the first trigger represents too much risk, if you're patient, there's a high probability that we'll get back above or below the trigger, whatever the case is. We'll trigger a second time. The second and third triggers usually require less risk and offer greater profit potential. We're printing a red candle right now below Well, we're definitely below the BBC. We're also below this weekly trading zone. So what we can discern from this 30-minute chart, price is currently trying to get to the weekly trading zone below. Price is always on the move, even when it's churning sideways. From Sunday evening at 6 p.m. to Friday afternoon at 5 p.m., price is trying to get somewhere. We, with the zones, have a point of reference, a framework, if you will, of where price is trying to go. And here it's trying to get to the zone below. So we want to be short the market, but where's our entry? Well, we can reference this range chart just like this. Okay. We just pulled up to the BBC. We've got on the other side of the BBC. If you're just looking at the range chart, you would go long here. This is a setup for a long trade. Oh, we have never actually pulled away really, but it's across, I pull away, pull back, up close, and off you go. But here, what we want to see on this 30-minute chart to align with that 4-tick range is I'd like to see this drop a little more, which on the range chart will put us back below. This, I believe, will turn into a head fake, as it's called. A head fake is just simply when the market looks like it's going to do something, and it actually does something different. If I draw a trend line from up here, now the trend line is on the range chart, so we've come right up to that trend line. So now what I'm looking for on my range chart, because on the 30-minute I'm below that weekly trading zone, that tells me price is trying to get to the zone below, and it's been trying for a while. This was our first indication that it was trying, but then that's just consolidation here, and then we spiked it pretty good. Remember, all you see is wick now, but during the life of this 30-minute candle, you had a big red candle here. From where it opened, down here was a red candle, then it reversed, headed back up, got back to the zone, and every one of these candles is touching the zone, so that's consolidation. Here we go. This tells us the market is trying still to get to the zone below. So on this time frame, an entry here at 30.26, 30.27, it's about a 10-point move to the zone below. And risk is minimal, but to further reduce the risk, you watch this, and we'll see it come down, most likely come down through the BBC. Then when it pops back up like this to touch the BBC and gives us a down close, now we've got everything pointing in the same direction. We've got our smaller time frame, we've got our higher time frame, we have the wind at our back, so to speak. So I'll go ahead and start on the Concierge Trade Alerts from last night. We'll recap those, and we'll just keep an eye on this. I'll keep the 4-tick range chart open. I'll just move it out of the way for the moment. Okay. Now the lines you see on the chart, those are the weekly trading zones. They come out Monday morning, 6:15 a.m. Eastern. We've published the zone since December 14th of 2009, so we're coming up on a 10-year anniversary. Price behaves exactly the same when it encounters a zone. The three things I told you, consolidation, rejection, and the slice, that's how it's been since we first published them. And looking at historic charts, it was doing the same thing long before, God graced us with the zones. So we're getting red there on the 30 minutes, so that tells you, okay, well, if I'm red on the 30-minute, on the range chart, we're back to the BBC. Price always reverts to the mean, and in our case, the mean is that green line. bull-bear cross. Prices below it, we anticipate lower prices. When price gets back above it, we anticipate higher prices. Now, once price gets above it, and we anticipate the higher price, the only thing that will stop us from getting a higher price is an obstacle. An obstacle, in this case, we've got the trend line right there. It could be a previous swing high or swing low, depending upon the direction that you're trading in. This is where patience comes in. Okay? You're going to just sit and wait till everything lines up. Or you can just simply trade what's in front of you. Michael does not bounce across different time frames or from the range to the 30-minute in the morning in the training room, because what he's trying to do in the morning is to simply show you the trade setup over and over and over as many times as it presents itself during the 2-hour session. Once you understand that, once you can read the chart, know what it's telling you, you know what to look for, then you can, bounce it off of higher time frames. Did you want to say something, Michael?
No, I was just agreeing with you.
Oh, okay.
That's what I'm trying to do.
Gotcha. Anything else you want to add right here at this point? Anything I haven't said yet?
No, you pretty much covered it.
Anybody in the audience, do you have any questions about this? Okay. This is the nexus of the methodology, the crux of the apostrophe, as Frank Zappa said. You'll always get an indication of a move on the smaller time frame first. However, that's also the place where you will get false starts. So see, we're still climbing here. We've taken out that trend line. We're still climbing. So now I'm going to look and say, well, there's a potential obstacle. There's a potential obstacle. There's a potential obstacle. And of course, this spot right here, where we got the last bearish cross, that is an important price, important area. So we'll draw this over here. We're even taking that out right now. So how does that reflect on the 30-minute? Okay. So hopefully that shows you the benefit of, if you're trading the 30-minute already, using that 4-tick range chart that you originally learned the methodology on. Not a bad idea to still go and check that, because everything here said, yeah, we're trying to get to the zone below, so I just need to be on that side of the street. But let me try to pick an entry that is both high probability and low risk. Had we just gotten short when I first started talking about this, we would have a drawdown at this point, of about 3 points or so, give or take. If we get back up to 30.27, that is a weekly trading zone. I think, 28. Actually, it's 28. Is that you, John?
It is.
Oh, hey, Dr. Tom. Hey, guys, it's Thursday, Dr. Tom Day. Okie doke. Well, welcome. Glad to have you with us. How are you?
Well, I'm right at the nexus, which is the center and the core and the link and the connection and the tie and the union and the crux of everything.
Well, you're a busy guy.
I'm right in the big middle.
Okay, guys, we'll do the recap after we talk to Dr. Tom. We'll go through the concierge, we'll go through the logic, all that, of course, in answers to your questions. Dr. Tom, would you like the chart or the screen?
If you please, kind sir.
All right. What are we going to talk about today?
Well, we're going to finish up on something we started a few weeks ago, and then we sort of wandered off a little bit.
Mm-hmm.
We're talking about the future of real estate, and I think that's pretty important right now. Are you seeing my screen?
I am.
Okay. With what I see coming up anyway,
I've got the main screen, how to benefit, and then I've got your slides over on the left. Now I've got just the future of real estate.
Now we're seeing the Jetsons here.
Did you hear about what they did in California? They turned all the residential lots that were zoned for single-family homes. You can now build 2 dwellings on that lot.
Really?
True story.
They're getting crowded over there.
Well, it's, affordable housing, etc. Prices.
And then they get taxed for it too.
Yeah, and Michael brought that up the other day that they can increase the property tax. So it's interesting.
Well, also we're paying for it to a large extent. I mean, essentially, California as a state has been bankrupt for a long time, and the other 49 states have been bailing her out.
Morally and financially.
Yeah.
They're under siege right now, though, with these fires. What a horrible thing. It's bad. Has it eased up any? I haven't looked at the news this morning.
At one point, they were 10% controlled and then dropped down to 5% controlled. But as you know, I used to be a firefighter. And what's happening out there could just as easily be happening in the other western states. It does to some extent, but not nearly as bad, because the other states are not controlled by eco freaks, and they're allowed to do what's called forestry management, which is number one, timbering, on getting the wood out of there, because a real crowded forest is going to burn a lot hotter, obviously. But also going in and doing what we used to do here in Florida, which is control burns. We'd go in there with a can of gas and spray it around, and we would burn off all the broken off branches, the dried up leaves, the underbrush, and so on. So, nature, the way God designed forests and so on, is for them to burn periodically. So if we went around at all, lightning will hit a tree.
Exactly.
A lot of that stuff will get burned off. And also, interestingly, there's some trees, the only way they can sort of pollinate is if there is a fire. They have pods, and if it gets hot enough, those pods pop open, so therefore more trees grow. So that's God's design. But man that comes in and says, well, we're going to build right up next to this dangerous forest. And so therefore, we have to control every forest fire to keep the houses from getting burned. Where it would be much better just to clear an area around the houses. And if a natural fire starts, let it burn itself out. That's the way it was for thousands of years. But it's because of the management of the state that they're really putting their people in danger. And of course, the other thing they could easily do is bury their wires. They're cutting off electricity to everybody because they're fearful of wires dropping to the ground and sparking a fire. That has actually happened. One of the big fires they know was started by a down power line, or the whole power pole's falling over. So the power company there is the single most regulated company in the United States.
Wow.
It's basically run by the state of California. They can't go to the bathroom without getting permission from the state of California.
What's it called? Pacific Electric and Gas, or PG, something?
Pacific Gas Electric, PGE.
Yeah.
They wanted to do a rate hike in order to have money to fix up some of their crumbling infrastructure. And the state wouldn't let them do it. They only let them have a portion of the rate hike that they needed. So supposedly they're protecting the people from raising prices, but what they're actually doing is putting the people in danger from these forest fires. So, we need some government, obviously, but we don't need 90% of the government that we've got. And if we keep on going the way we are, the government's going to ruin everything.
You think?
I think, yeah. Anyway, if you remember a few weeks ago, we talked about the future of real estate. And we wanted to talk about the past, the present, and the future. So we got through the past and the present. Just a quick recap. Everybody thinks they're going to get rich in real estate. And the people who get rich are the people that sell these courses for thousands of dollars, these books on how to flip houses and all that kind of thing. It's just not as easy, obviously, as they make it seem. But the people that sell the information about how to get rich are the only ones that really get rich. So past, present, and future. Real estate, financial, stock market crashes are no new thing. This is 1929, the Wall Street panic. There's the Dow crashing. And the causes of that crash were regulatory incompetence. They allowed 10-to-1 leverage. The only reason I mentioned that is because that's what caused, in our lifetimes, the crash of 2008. It was 10-to-1 leverage in the housing market. It wasn't a real estate crash. It was a stock market crash. It was a stock market crash secondary to a housing market crash. Okay, so there never used to be mortgages in this country, but when there were, you had to put 50% down. Well, these days, 10% down, you can put $10,000, control a $100,000 house. So if it's just a normal housing correction, it will turn into a serious problem. Just like a normal stock market correction of 10%, when it was leveraged 10-to-1, caused a huge panic. So you think we would learn from history? You think that mortgages wouldn't be so generous because 10-to-1 killed us in 1929 and in 2008. But they did stop the over leveraging of stocks. It's now basically, 2-to-1 or 4-to-1 on day trades. But they have not reformed the mortgage market. So the present, the Community Housing and Development Act of 1977, which was put on by good old Jimmy Carter, the peanut boy. He forced lenders to make unsound loans, to make loans that the people didn't have the ability to repay, and they lowered down payments even more, so people had less and less skin in the game. By the way, a little aside here, have you ever seen that book, Dwayne?
Jimmy Carter. I think you showed it to us once before here on the show, or maybe it was when we started this talk.
It might have been. Yeah, I think it was, because I'm right now just sort of recapping what I did last time. But this book was an eye-opener for me. I was actually, for the first time in my life, getting involved in politics, and I was campaigning for Jimmy Carter until I read this book. And this investigative reporter, Gary Allen, did a fantastic thing. He's got, Jimmy Carter. When you open it up, on the left-hand side of the page is his campaign positions when he was running for governor of a southern state, Georgia. Mm-hmm. On the right side is what he said when he was running for national office. And in every case, they were diametrically different. At one point he said, I'm a George Wallace. I'll lay down in front of a school bus before I'll allow our Georgia schools to be integrated. Well, when he's running for president, integration was very important. We have to get it done, So
I did not know that about Jimmy Carter, and I grew up in Georgia. I didn't know that he opposed segregation of the schools.
When he was running for the first time for governor, he sure did, yeah. Read the book. You can get them real cheap now because it's old,
Yeah.
and you
Well,
can
it was
get them
only
on
$1 when
Amazon.
it was printed, according to the cover there. If you turn your head sideways, you can see it.
Oh
But that was
yeah,
back in the day. So
and it's a very small book. I mean, you can read it in 30, 40 minutes. Anyway, moving along. Slick Willie and other criminals passed the Graham-Leach-Bliley Act, and it expanded the reach of the Community Reinvestment Act even more, and he started aggressively enforcing it. So we ended up with not just low down payments, we ended up with no down payments. If you were really broke and had really bad credit, you could get rebates when you bought a house. They had 110 and 120% loans, which means if you bought a $100,000 house, the lender would give you another $10,000 or $20,000, and they would only charge you interest on the principal. They didn't make you, or just interest on the principal only, interest only loans. They didn't make you pay down the principal because you couldn't afford it. And of course, somebody living in a $500 a month, 700 square foot apartment buys this 2,000 square foot fixer upper with nothing down. Clinton writes him a check for 20 grand for the purpose of fixing it up to make the house more valuable and be worth the 120,000 mortgage, but instead he uses it to buy a big Cadillac with.
right.
He pays interest only, $500 a month for 5 years, which is the same as on his apartment. So he's got 3 times the space for the same price. But as soon as they notify him, okay, now you have to start paying principal, so your mortgage is going up to $1,200 a month, he just walks away from the mortgage and moves back into another $500 a month apartment. That's really the roots of the crash of 2008. Okay. And of course, Fannie Mae and Freddie Mac, Bonnie and Clyde, which used to be independent organizations, but the government had to take them over because they messed up so bad because of crimes, really. If you have time, go on YouTube and search for Democrats covering up the Fannie Mae, Freddie Mac scam, and you'll see some amazing things. Democrats cursing out federal officials because they had the temerity to bring up the fact that instead of the 10% reserves they're supposed to have, they had as little as 2%. So anyway, let's get to the future. Okay. Oh, by the way, they praised this guy, Franklin Raines, and he was giving himself bonuses of millions of dollars a year bonuses.
Wow.
As his organization that he headed was losing millions of dollars a year. Okay. So, but at the hearing, all the Democrats were protecting him, saying this is a political lynching and blah, blah, blah. But later on, he was fined millions of dollars for his crimes, and he barely avoided going to jail. So, here's some books that I think everybody should read because they tell you the real roots of the meltdown. America's Bubble Economy predicted it back in 2006. And then the book that they published afterwards, Aftershock, like an aftershock after a earthquake, talked about the results of their predictions, and then they talked about how to protect yourself and profit from the next global meltdown. So we're going to talk today about how you can profit from a real estate crash. But at Aftershock, remember they were the only people that accurately predicted 2008, 2 years before it happened. In Aftershock, they're predicting another real estate crash, a major stock market crash, and gold going to the moon. So it's good reading. These guys don't just make guesses. You know, there's a lot of these commentators that say, well, stock market's going to do this or that. And every once in a while they're right. And then they advertise that. They don't advertise the 9 out of 10 times they're wrong. These guys actually looked at real things like they predicted the housing crash. How? Not because somebody they were reading said the housing was going to crash. They looked at numbers. They looked at the fact that wages were gradually increasing while housing prices were going up like crazy. All you have to do is just look at that chart and you know the housing's going to crash, because if people's wages can't keep up with it, then their house is going to get foreclosed. The rule of thumb used to be 20 to 25% of your total income is allocated to housing. Now for most people it's 35 to 40, even 50%. So that's why you had the crash. Anyway, moving on. Let's look at the future. One of the best indicators of the fact that we're going to have a crash is dead and dying commercial properties. Malls, strip centers, office buildings. Here's the formula. If you have less than 50% occupancy, your property's going to die. And I'm going to prove it to you. I spent half a day just driving around Palm Beach County, one of the richest counties in the country. And this mall was once the largest outlet mall in the country. What's the largest mall, not outlet mall, largest mall in the country. And if you look underneath it there, between the two pillars of the sign, you see another building over there. That was the Sears store for automobile things, tires and whatever. It was the largest Sears store in the country. So why would the shopping center fail? Well, they started losing tenants, and as they got closer and closer to 50%, more and more tenants moved out. Because the idea is people come to visit JCPenney's, and while they're there, they see your electronics store and they come in and buy something. If you noticed on that sign there, they said JCPenney here to stay. This was when they were down to 2 stores in this entire 86-store mall. There was a music store and JCPenney here to stay. We're not going anywhere. Well, a couple months later, they were gone. That's JCPenney's store there. It basically became a ghost mall. You've heard of ghost towns. Mm-hmm. This was my bank. I did my banking there because in the big building off to the right, that's where I was a stockbroker. I had the corner office on the top floor looking over all Palm Beach County, running a stockbroker, and I would walk over here to do my banking. Sears, Dillard's, Macy's, Penny's, all of them big major chains, they all failed, even though nationwide they were doing fine. Of course, Sears is not doing fine these days, but back in those times they were. But they're all gone. And the irony is that they're within a half a mile of very prosperous buildings. The building I pointed out to you before is on the left. That's the Forum building. 10 floors, hundreds and hundreds of tenants. There are actually 3 identical buildings. This is in front of the other 2, so you can't see the other 2. Across the street, that glass building, that's still a very prosperous place. So why did the Palm Beach Mall die and these other buildings prosper? Okay, it's because they didn't take care of the place, they didn't keep it clean, didn't have good security, and as tenants moved out, they started raising the fees that the tenants have to pay, the common area fees, and eventually they dropped below 50%, and then they were gone. Like I said, this is once the largest Sears store in the whole U.S. It took up 1/3 of this huge shopping center. Here's one I found after I left there, a very nice strip center, and it was fairly new. It was only about 10 years old, Woodbine Commons, but it was 2/3 empty. When I drove in there, you can see there's no cars around. It went out of business. There's one of the dearly departed businesses there. Nothing there. If you go up to the window, nothing in there. Parking lot was empty. Here's an executive office building. They got so desperate for tenants. Look at this. There's 10 signs. There's 10 tenants in the building. Only 4 of them were occupied. Well, it's 40%. That's less than 50%. They died. They were so desperate for renters that they were discounting these suites, giving free furniture, free telephone service, free internet, fax service, just giving the store away, hoping to attract some new tenants. Now, I'm not claiming to be a prophet or prognosticator, but I can read the tea leaves a little bit. In 2006, I wrote in my Conservative Truth, which is, by the way, the oldest Christian conservative website on the internet. We're now 20 years old.
Wow.
There may be others that
Congrats.
started before we did, but we're the oldest continuously published. I know one other one that started a year before we did, but then they shut down for 2 years, and then they started back up again. We published every week except Christmas week for 20 years, so it's our birthday.
Happy birthday.
Thank you. So here's what I wrote in one of my articles. Nationwide, some landlords are carrying tenants who are behind in their rent as much as 2 years. Why would they do that? Why would they just let tenants stay there without paying rent?
Well, it's better than having it vacant where it can get vandalized, perhaps.
That's right. That's right. It's because, as we said earlier, commercial properties with less than 50% occupancy die. And the fewer occupants there are, the higher the risk is of robberies because there's not so many people around. The common areas, again, aren't taken care of as well because they need the tenants to pay the common area maintenance charges. And so their thinking was, well, at least if we look like we're occupied, maybe these tenants will eventually catch up with the rent. But they didn't. They closed down, and it's happening all over the country right now. This is a disaster waiting to happen. Last time the housing crisis, which led the stock market crash, the housing crisis itself was led by residential real estate, and then commercial real estate started following along with it. This time I believe it's going to be the opposite. Commercial is way overpriced, and of course residential will go with it because it's just like in the stock market. There's somebody, like in the 90s, it was the tech bubble that caused the crash. But what happened? After the tech stocks started going down, the other stocks started going with them because people look at the stock market as a monolith, just like they do real estate. Now, one interesting thing is that real estate or foreclosures bottomed out, and the least foreclosures in several decades in 2018. So there's a lot of foreclosures after the crash, but it was recovering. But just this year, in early January, they announced that there's been an uptick in foreclosures for the first time since 2008. So is this going to be deja vu all over again? Here's the bank failures of 2009. Now, to put this in context, in 2005 and 2006, there was not one single bank crash. In 2007, there was 3. In 2008, when you'd expect to see a huge number of bank failures, there were only 22, because it took time for the stocks crashing and the real estate crashing to work its way through. Banks have ways of protecting themselves, but it only lasts for so long. So in 2009, there were 443 bank failures, and then a lot more, less in 2010, but a lot more crashes, bank failures. and then 2011, and then it started upticking with less and less failures. But look what's interesting, those second and third columns. The states, Georgia all the way down to Texas, are ranked by the number of failures. Okay, so Georgia had 82, Texas only had 9, but that was a lot more than the other states. But look at that in the next column as a percentage of the failed banks in the U.S. It's the same progression. Okay, so Georgia had the most failed banks, and they had the highest percentage of failed banks in the country. Florida was second, and so on. Okay, this chart is a few years old, but the Fed was ranking problem institutions, the FDIC's problem list. So they're not actually failures, but they're getting there. So what's in our future? This is what I believe. We're going to see another commercial real estate crash like we had 40 years ago, when real estate was so overpriced that the insurance companies, which held most of the mortgages on the big commercial properties, were left with mortgages where the properties were only worth a third of their mortgage price. So a lot of insurance companies failed during that time. The insurance industry, as you know, doesn't allow failure because it makes them look bad and people wouldn't buy insurance. So the bigger companies gobbled up the littler ones. But there were actually a number of bankruptcies of insurance companies because of that real estate crash. Well, back then there was a spillover into residential real estate. And I think it'll be just the same thing, but opposite this time, because real estate is way overpriced right now. Every real estate agent I talk to, if they're talking to a potential customer, they're real bullish on real estate, but they know I'm not going to buy any real estate. So they tell me the real truth, and that is that they're losing agents. One guy told me he used to have 40 agents. He's got 4 now, and the rest of them are waiting tables or working at gas stations. So it's starting to happen. I mentioned the 1990s already. In the 1990s, the investors didn't discriminate. When they decided they didn't like the stock market, they decided they didn't like any of the market. Some of the big cap stocks did do a lot better, obviously, but they still went down. For 2.5 years, starting in March of 2000, after 10 years of everything going up every year, we had a failing stock market, led by the techs, but still the big guys were hurt too. Insurance company failures, already mentioned that, and I think that's going to happen again, only this time they're not going to be able to bail them out. There's no insurance companies big enough to bail out all the failures that will happen. So if you've got insurance, make sure that you're with a highly rated company, and even that may not protect you. And don't buy annuities, because annuities are insurance company products, and they invest in the stock market, and they do a worse job of it than a lot of the people that run the IRAs and the 401ks, and that's pretty bad. So we'll see more bank failures. So to recap, we've got an overvalued real estate market, a potential commercial real estate crash after foreclosures dropping for the last 6 or 7 years. They're now starting to uptick. There are economic threats out there. I'm going to talk about this in another show. We see the economy is just really doing great because we keep hearing all the talking points. Lower taxes, less business bankruptcies, and so on. But there are some economic threats that are not being paid attention to. And I'm sure you're aware of those, Dwayne. A lot of the banks are very shaky. So the real estate market really is not for amateurs. At this point, it's not the time to get into it. In 1980, you could be a total blithering idiot and buy any kind of real estate and make a ton of money because real estate was going up 10% a year. It really wasn't. Inflation was going up 10% a year, but everybody thought they were geniuses because you put 10% down in a house and you could sell it a year later for 10% more. So you just doubled your money. Everybody was making money then, just like in the 1990s. They did this, I think I told you about this tweet, it was funny. They put up a list of all the stocks on the stock market, and they trained monkeys to throw darts, chimpanzees, at these walls. And then they would go out and buy the stocks where the darts stuck in. And they were doing better than a lot of the professionally run mutual funds. So chimpanzees are smarter than money managers.
That's funny.
It is funny. So it's the same thing now. You know, I believe in real estate in general. I believe in hard assets, precious metals, and real estate, because they're not making any more of either one of them. You can print more stock certificates. You can print more bonds. You can do a secondary IPO. There's all kinds of ways to create more paper. The government creates paper all the time, not just money, but also treasury notes. So when everything's going up, a rising tide lifts all ships. But in the 90s, you didn't have to know anything to be an expert in the stock market. But after March of 2000, you better know what you're doing, or you better know how to short. And the same thing happened with real estate in the 80s, and it's going to happen again. So this is not a market for amateurs. Now, that's all the bad stuff. Here's the good stuff. You can benefit from a crash in real estate. My favorite way is land banking. That's a no-brainer. That's the way President Trump made most of his money. It's just like what it sounds like. You bank your money in land rather than in a bank that might fail. You say, well, I'm not worried about bank failure. They got the FDIC. Did you know that the FDIC almost ran out of money? It was down to 10% of its reserves. All it would have taken was one more major financial institution failing, and the FDIC would go down and banks would be failing wholesale, or the government would have to somehow miraculously come up with enough money to fund it, because the government does not fund the FDIC. It's funded by taxing banks. They don't call it a tax, but every bank has to make contributions to the FDIC. And whenever there's a bunch of bank crashes, like there was in 2009, they assist the banks more. But if there's a whole bunch of banks going out of business, then there's no banks to assess, right? So the last place to go is the federal government. And I don't believe that the federal government is going to be able to handle it. Now, another way you can make money is the way some people make money in stocks. Wait for the right time to go in. Don't try to buy at the bottom. Just like when you try at the bottom in stocks, it's like trying to catch a falling knife. You know, oh, I'm sure this is bottom. Well, how do you know it's bottom? Well, look how far it's gone down. What you think, what you hope, the market could care less about your ideas. It really doesn't care. And if you think that this is the bottom and it's not, and you go in and buy and it keeps on going down, you can get really hurt badly. So the only way to know when a bottom has been hit is, for sure, is when it starts to go back up, whether it's stocks or an index or real estate. And even then, that's not always the truth, right? Sometimes it goes up and then turns around and goes back down even more. So I usually wait for at least 10%, preferably 20% retracement, because I'm smart enough not to be greedy and try to buy at the very bottom and sell at the very top. But if you know how to do it, then you can make money when real estate drops a lot. A lot of people did make money in 2008, 2009. If you're experienced or if you have a trusted professional, remember that select markets pop earlier than others. Stock market is national. Gold is national. Real estate is regional. And if it gets bad enough, it goes throughout the country. Like during the crash in 1929 and in 2008, it was hard to find any pockets where real estate was going up, much less holding its own, So if you're not experienced, other ways to invest in real estate that are hands off to where you don't have to have the knowledge are land banking, which I mentioned. That did very well in 2008 and 2009. And what they do is they buy land in the predictable path of development. And if you get in touch with me, I can give you the names of some people that do that sort of thing. And they manage everything for you. And you can even invest from your IRA or other retirement plan. A solid real estate fund, especially one that's been around for a long time and has a good management. Same thing for ETFs or REITs. Not a big fan of REITs because they tend to focus in too much on one area, like only nursing homes or that type of thing. But do what the Bible says to do and diversify. So that means don't forget gold.
Gold?
One of the best. I'm sorry.
I said, did you say gold?
I said gold.
Okay.
Don't forget about gold. If you want safety, you want tangible assets. And as you've heard me say many times, if you can't hold it, you don't own it. Well, one way to get a tangible asset that you can hold is to get precious metals. And every time there's been a real estate crash in this country, the smart people have run to gold, and they've come out better than they went in, particularly collectible gold. During the Great Depression, there was only one asset class that went up, and it was collectibles. Okay? They were printing bonds like crazy. Even though stocks were dropping, they were issuing more shares. They were doing anything they could to try and get some cash in the door. But the smart people are going out and buying up collectibles. That's not just collectible coins. People made money on collectible antiques, rare paintings, shotguns, antique shotguns, all kinds of things. But if we're looking at a real crash, and again, I don't want to sound like Mr. Doom and Gloom, but if we have a serious crash and we're due for one, the stock market is up so much, far more than it was in 2008 on a percentage basis. It's just more vulnerable. So we could have a dollar crash to go along with real estate and stock market crash. And then it might be necessary for your family's safety to get out of Dodge, to move to a safer area, because big cities are not going to be where you want to be. That's where you're going to have roving gangs of guys with guns, and they're going to be coming for your stuff. So you might want to go to the mountains and find yourself a little place where there's not any good roads into it, and where you can control the high ground with your AR-15, And if that happens, I could put my net worth in my pockets, or at least in my car, But if I got big antiques or paintings or whatever, I can't do that. The other reason I like collectible gold better than other antiques or other collectibles is that there's two kinds of value to collectible coins. One is the bullion value, or just the pure metal, what you could sell it for, are traded for just for the gold. So even people didn't understand the rarity value of it, it's still gold. But collectible gold or investment grade gold has two kinds of value. They have the intrinsic value of the bullion, and it has the extrinsic value of its rarity, whereas other collectibles only have extrinsic value. I mean, what can you use an antique painting for? Really nothing.
Right.
So a multi-million-dollar painting might be worth $4 or $5 intrinsic, because that its only intrinsic value is the wood stretchers and the canvas. An antique that sells for $5 million, like a Louis XV armoire, it's got $10 or $20 worth of wood and some hinges, so it really has no intrinsic value. So investment grade gold has both intrinsic and extrinsic value, and that's why I think you should go to CFRNgold.com and get in on the gold investment starter package, because it's got a lot of great information on how you can benefit from crashes. One of them is an article called the 10-10-10 Financial Survival Plan, and it's how you can actually survive a crash. That's important information. There's also a lot more information on the investment grade gold itself, how it works. I went to the wrong place, sorry about that. There it is.
CFRNgold.com.
That's right. Let me see if I can make it bigger. There we go. So you go there, and if you fill out the form, you'll get the Gold Education Starter Package, but you'll also get an invitation to the financial education webinars, which we have people from all over the world listen in on those. So you get a free invitation to it. If you can't attend it, but you want the information, we post all the webinars the next day by noon Eastern time. If it's just not of interest to you, well, just delete that email, because probably the subject next week will be of interest to you. So we have two different kinds of webinars. There's the Christian Financial Concepts webinars, which talk about finance in general, particularly from a biblical viewpoint, because the Bible has a lot of wisdom on finance. Haven't you noticed that, Dwayne, in Proverbs in particular?
Oh, yeah.
Where the Bible tells you how to make money and how to keep from losing money. But then every other week, we also have gold webinars where we focus in on that, because right now that's where all the smart money's going. It's going to gold. So,
very good.
Do we have any questions?
There was a question from Tim. When you say land banking, what exactly are you talking about?
Well, what happens is, and I'll use President Trump for example, we have a Trump Plaza here in Palm Beach County. Well, he bought the land that it sits on years ago, but nobody wanted it. But he was smart enough, or he hired smart people to figure out where the development was moving. And, John D. MacArthur, most people hadn't heard of him, but he's real famous here in Palm Beach County. Like I said, one of the richest counties in the country. Mm-hmm. And he used to own half the county, half the land of the county. And he said, if you want to get rich, just buy land, and eventually it'll get in somebody else's way. So that's what Trump did. As the development moved towards the land he'd bought, then it became worth a lot more. And normally when you build a commercial building, you have to put up your land and a pretty good sized down payment in order to get a construction loan. His land had gone up so much in value, he didn't have to put up any cash. He was able to borrow all the money needed to do the construction, and then just roll the building and the land together into a much smaller mortgage than it would have been. So he hasn't made his money on golf courses and office buildings and hotels. He's really made his money on land banking. Now, how can I do that? Well, I found a company that I really like. I investigated it thoroughly, and I actually did a webinar on it. If anybody's interested, just contact me. You got the contact information there on the screen. And my wife and I both put all of our IRA money in it. You can buy gold in an IRA, which would be my first choice, but basically they only let you buy gold bullion, and I wanted to buy investment grade gold, and I already had like a lot of gold. I mean, like 70% of my net worth. So I decided I would get some land, but I wanted to buy land the smart way, and I didn't want it to interfere with my ministry, with my business. And now I'm teaching at a Bible college, so I'm preparing classes and so on. I don't have time to manage real estate. So they take care of everything. I just buy the land, and when the time comes, when the development moves towards the land, then they sell it for you.
Interesting.
It's a pretty cool concept.
Yeah, sounds like it.
And they use something I call the Walmart indicator. When Walmart,
okay, I think you've heard me mention that before.
Yeah, when Walmart builds a super center, they build it to service 250,000 people, and they have to get the permits and break ground and build that long before the people come. So they spend millions of dollars in research. This company I do my land banking with, they piggyback on Walmart's research. They find out where they're pulling permits or where they're buying land, and then they buy land in the same area.
Clever.
And sit on it until it goes up. Yeah, it's pretty cool.
Very clever. I like that.
Any other questions?
I believe that's it for today. Thank you
All
so
right.
much. Really appreciate it. Agnes is coming back in November. Little D has to get his passport renewed. He has dual citizenship. I think she'll be passing through your way on the way back to Africa at the end of November.
Well, good. I'd love to see her.
All right. Well, she wanted me to mention it to you, and I'll let her know that you look forward to seeing her.
Tell her to give me a ring.
All righty. Thank you, Dr. Tom.
All right.
All right.
God bless you and your whole audience there.
Thank you, sir. We really appreciate you. We'll see you next Thursday.
Okay. Bye-bye.
Bye-bye.
Really? Here.
Okay. Let me get the charts back over here. All right, John, let me open up your mic. Hey, John, welcome to the show.
Hi there. Sorry I couldn't get on before Doc.
Oh,
Tom.
no problem.
But, yeah, the to be fair, I think we kind of laid out the scenario pretty well yesterday. It kind of worked out pretty much along the lines of what we thought. There was a little bit of a spike in the market before it took off. I said to use the market strength to sell and go short ahead of the vote, and right now that would have worked out pretty well. We're not tanking yet, but the vote was looks like this vote was negative for Trump, and the impeachment inquiry or whatever it's going to be is going ahead. So it's not having that much of an impact just yet, but I think if we were to break down lower later today, could be a problem. Also, I think I mentioned, I believe it was 2007 when we had the what does it mean? The 20th anniversary of the crash of '87, I think. We got through the date, and a couple of days later the market tanked. Today's that day for this market, so keep that in mind. From the anniversary of 1929, the 90th anniversary. Gold went exactly, it had that down spike. Remember, it didn't go down and test the 1460. It got down to 1485 or something like that. And then it turned on a dime and recovered pretty strongly. Somebody was asking me about the nugget and the J-nug a short while ago. And if you would be good enough to put up the weekly J-nug or the nuggets, I think you'll see that we have the makings of a pretty strong buy signal, weekly buy signal.
Okay.
And generally speaking, those kinds of things have a pretty profound follow-on move. I looked at the previous J-nug, similar kind of a buy signal, not necessarily as good as the one we have right now, and it pushed the J-nug from about 85 up to 105, which is a pretty good rally. So obviously,
just a second.
yeah, it honestly looks like the market's probably not going to rally later today. There's some report. I haven't seen it yet. There's talk of a report out of China saying that the likelihood of a trade deal being done is slim to none or something like that. And I guess they didn't like Pompeo's speech on Wednesday. I think it was yesterday, where he said that China, we sort of helped China, hoping that they would become more free, and the Chinese Communist Party has sort of basically took advantage of our generosity and has become very hostile. So the Chinese don't like it when they have speeches like that. And they had another speech the other day that Pence put out, and that they didn't like that one either. So I guess they've kind of gone on a bit of a go slow on the trade deal right now.
Hey, Don, I put up the J-nug weekly. I got to step away for just a second, so you go ahead, keep going.
Okay.
And I'll be right back.
Well, we've got a doji bottom there 3 weeks ago, and we've been going up since with a kind of a test of that doji bottom, and we're gradually turning. That's a fairly, look at the last weekly bottom back in November. That one was somewhat different. I think you could argue that this structure here is a lot stronger than the one back in November, which actually produced a pretty good rally. We went from 30 to 60 to 70, more than the double. And look at the way it started. It started on a downer and reversed and went higher. I think I mentioned that yesterday. That was a Fed move where that actually was the bottom. The Fed, I think it was early December when that happened, and it, or maybe it was mid-November, something like that. But that was the low. The day the Fed didn't. I think the day the Fed raised rates, it right after that the market recovered. So even this last one in May was a tough bottom to pick, because look at the way it happened. We were kind of going down, then we had a couple of doji type weeks. It's always a good idea when you see, I used to follow Peter Stadelmeier, the market profile. I was kind of like a star student of his, and he always said, his theory was, if the market's not facilitating trade, in other words, the market gets to a certain level where it's just that the volume dries up, and next thing you know, you start a new trend. And look what happened here. You had a couple of a triple doji week, a little bit like this doji here, but it was a green doji, as here, this was a classic doji. Unfortunately, the plus is in the way of it, but you can see that it. You get what I mean, and look at the ascent we had. So, I wish I'd, even though we call that bottom, almost to the dollar. I wish I had been looking at this chart a little bit more at the time, because obviously the key development was when this week before the big green week was actually breached on the upside. That would have been a phenomenal buy signal. It would have kept you long from 35 right up to 90 or 85, almost a triple. What an incredible move. And then it, after a bit of a pullback, and next thing you know, we're pushing 100. So right now, look, a thing that a lot of people probably don't know is that, on the way up, if we were on a daily chart, you'd see that we had a series of 1-2s, and then we have this potential a huge 1-2 here. So this, wave one was from 30 up to 100. This is a pullback more or less to 60, a pretty reasonable pullback. You could call it a 50%er if you want, or barely a 50%er. Didn't quite get there. That's kind of bullish. But the next move is proportional to the size of the 1-2, to this correction here. So when you see that, it gives you some kind of sense of where we could go in the next move, which would probably take us to $1, 150, which would be a tremendous trade from here. Maybe a 90 pointer. Or 90 pointer from yesterday and an 80 pointer from today. But look at the speed with which we've gone up here just in the last couple of days. We were, like last week, we were down in the dumps, and I think I suggested, take advantage of any kind of a dip to get long, and the market sort of has bailed us out nicely so far. So this is quite an unusual bottom here in the sense that it's tested several times, and given that we're getting towards the end of the week, if we close anywhere around here or higher, and remember, it's the end of the month as two. The monthly structure on this doesn't look so good, but that's what makes this business difficult, because when you look at the monthly, you say, oh my God, I don't want to buy this thing here. But when you look at the weekly, you can see that it's kind of broken the weekly downtrend already. And you could be surprised by how quickly and dramatically the market could move, especially with all this impeachment stuff going on. And the market is breaking down. I meant to say that when Dwayne had the S&P chart up a minute ago, was already starting to break. So I'm getting a sell signal already on this new work that I've been telling you about. It basically on the ES gave us a sell signal this morning at 2043. So we're down to 3043, my apologies, and we're down to 3027 already. So actually we've been down to 3022. Got a small buy down there, and right now looks like we're heading lower again. So in fact, we're probably down. That's a delayed chart. I haven't got the sub going on that yet. So we're probably down towards 3022 already. So pretty big day so far. That's like that's $1,000 move today already. So, and it's the same with the Nasdaq. The mid cap is looking pretty grim. All the gains in natural gas from a few days ago are giving up their gains. The oil has come off quite a bit today too, and right now the gold and silver are kind of picking up again.
I'm back. Sorry about that.
Yeah, I was just telling everybody that actually on this new work I'm developing, Dwayne, we got a sell signal this morning on the ES at about 3043 up around there, and so far it's about $1,000 move, I think. Not bad. And it kind of looks like it's going to get worse. The JNUG. Let's have a look at Newmont, if you wouldn't mind. Can we go to daily on the JNUG? Just to sort of while we're there.
There we go.
Yeah, I mean, very strong. What do you call that thing? A hammer or something, or the doji yesterday?
This guy right here, yeah, that's a hammer.
Yeah, that's a super bullish deal when you see that very rarely fails. So we're right at that resistance now. So a clear breakout above 70 is probably going to send this thing up to 85, possibly quite quickly. And if you can go to Newmont now.
Okay, you want that on a daily?
Yeah. Yeah.
There we go.
Sorry, just a second.
All right, guys, stand by for a second. John will be right back, and I got to do something real quick. I'll be right back.
Sorry. Hello? Yeah, hi. So, actually, if you could squeeze up the Newmont a bit.
Yeah, sure.
I mean, look at it. It really is a kind of an extraordinary chart compared to, it went from 30 to 40 and it's had a very, very mild pullback. And it just looks like, look, I don't think it's going to set the world on fire in terms of upside performance, but, probably get to 50. And if it gets over 50, it might go to 60 or 70. So, I mean, if we do see a run up to 2000, by the way, you've got a kind of a huge island bottom there. Do you see that? Where it went down in May and then went up. It's kind of a.
Oh, this one right here.
Yeah. It's a pretty big deal. That. So, I think in terms of safety, that's probably a pretty good. You might. Who knows if the earnings? What does a D stand for? Their dividend? Is that a dividend?
I think it must be. Yeah.
Yeah. So E, the earnings are coming out.
Dividend right there.
Early November, and that might be a gap up situation. I would say this: if the earnings come in better than expected, I'd probably buy the stock just like right there and then, because the thing about earnings is they do drive the market, and if the earnings are better than expected, they're likely to drive the stock substantially higher, especially if the gold and silver situation improves. So that's a very a very interesting situation in terms of the gold stocks, and the fact that Nugget is starting to outperform, JNUG is starting to outperform Nugget is also a good thing. And I think the market probably handed us a real gift. If you want to just put Royal Gold up, RGLD.
RGLD coming up.
Yeah. It probably got, by the way, the Nugget, the JNUG, made a double bottom against like a multi-day double bottom yesterday. And I remember what I said about double bottoms being really important in a bull market. It looks like we said this a while ago. We actually said that Royal Gold could come down to, maybe 112. We actually said 112. So if it gets down to 112, looks like it's going to turn, could be a great place to buy it. And, I'd say the day it passes 120, you'd probably want to buy more because, this is really just an extraordinary leader of the gold sector. It's acting like an ET, it's acting like a triple ETF, and it's a regular stock. So, it's gone from 80 to 140 in like 4 months, just staggering. So you kind of get, it's probably, the market has a way of doing things. It's just the same way as important prices and important levels are always, tested.
Right.
You've got that gap at 100, will that ever get filled? Maybe not. You got gaps all the way up, but that one at 100 is a pretty big deal. And as you know, the market likes to gap through big numbers with authority. So 112, 110 might be the best that this can get to before it suddenly turns up and takes off again. And if gold goes up 200, it probably means this stock goes to 200. How about that?
Right.
That's because a $200 increase in gold is probably going to go straight to the bottom line on this company. And it's very important that people understand that. If in a case of a junior, if you're doing 6 or 7, like 700, 8, or let's say 800,000 a month, and your operating is 300, and you're making $500,000, and then the price of gold goes up $200, you're probably going to get $1 million in revenues, and you might have, your operating doesn't change. That goes straight to the bottom line. So instead of making $500,000, they're making 700,000. That's why junior stocks. If there is a roaring bull market and we go north of 2,000, there'll be especially 3,000. There'll be junior stocks out there that'll go up, anywhere from 10 to 100 times. It happened before, and it'll happen again. And in the look at today we're in the thousands in gold. We got to 875 in the 70s or 1980, and there were gold stocks that went up 300-400 fold back in those days, 300 to 400 fold. Some of the leaders, and the same thing happened in the Depression, and it kind of echoes what Tom was saying in the last segment. I'm not, by the way, I know that real estate, he's certainly probably a better analyst of real estate than I am, but he's probably got a point. This is what people don't understand. But we broke this news on this show the day the Fed started raising rates. Be careful, because this time it's different. You can't, in the real estate business, you can't raise rates tenfold, which is effectively what they did. That's why Trump's right, and it's to be beating up on the Fed, because they probably didn't know themselves the havoc they were going to cause, down the road. And if they hadn't done what they've done, there's a very good chance the stock market could be a lot higher and the economy could be a lot stronger. because they really took a wrecking. Listen, they didn't take the ultimate wrecking ball to the economy like the Fed has done in the past, but they certainly got a lot of whiplash into a lot of sectors, and hopefully that's improve. It's going to improve now because the Fed is raising rates, and the dollar is. Oh, you should be looking at the dollar, Dwayne, if you wouldn't mind putting up the dollar, because it broke down a bit today, and but I think if we get a lower dollar, a lot lower dollar, we will get it. We'll get that inflationary component that he was talking about in 1980. That actually could come in and rescue the real estate or postpone the downtrend he's talking about. Listen, the downtrend he's talking about is coming, but he might be 10 years early. Who knows? He might be dead right. Look, if we get a crash in 21, like we were thinking, for sure, he's going to be, he's going to be dead right. And if gold goes to 8,750, like I think is my target, we're all going to be right. But by 23 or so. So the dollar is breaking down, and by the way, you see how it's sort of, this is the thing to be looking out for. You see how it's spiked up this morning or yesterday on the Fed,
right?
Then it came off, right?
Right.
I mean, that's sort of like when you see that, it strengthens the sell signal, and look at the dollar. It's easy with hindsight, but if you actually shorted each of these spikes on the upside, you would have made some nice money. Yeah, exactly. And it's not so easy on the bottom. You see, it was kind of easier picking the tops on the dollar than the bottom, except for the rally over back in May. But this really does look like the beginning of the end of the dollar here. And remember, look, these are just projections, but 4 years from now, supposedly the debt is going to be double. It's going to be 700 billion, right? The debt service, rather, the servicing the debt of 23 trillion is going to be 30 trillion. The debt's going to be close to the 27 to 30 trillion, and the debt, the cost of servicing the debt's going to be 700 billion. I mean, listen, right now it's 250. You go to 700 billion, that's $450 billion down the drain. That's not building anything in the economy. It's just sucking the life out of the economy. And it's a big negative. It's a drag on the economy. And, probably by 2030, we're going to have $1 trillion or more debt service. And, we're going to probably have a big, we will have a depression. And mainly because of automation, I believe, but maybe other factors as well. And there may have to be a whole, complete workover of the currency and everything else to restart the world economy. But there's trouble ahead, and so it's wise to be warned and certainly be prepared for it. And look, why? I'd love to get somebody like, not that we ever will, but it would be interesting to get Sam Zell on this show and ask him the question that nobody else has asked him really. Why are you buying gold? You've been rich enough your whole life to be buying gold since it was $35 an ounce. What makes it such a great buy at $1,300? Or $1,250 or $1,300 when he started buying gold for the first time in his life. Right. This is the smartest. I mean, the guy's worth about 40 billion. He's one of the smartest guys that ever walked the face of the earth, and he's buying gold now. He's not buying it for a double or triple. This guy, he's buying it for something much bigger, I think. So he's one of the he's like the Hunt brothers of the 21st century. He's an early mover. Along with the war, there was a fellow who used to manage money with Soros, Druckenmiller. Yeah. Right, one of the most successful investors of all time. These guys are buying gold, the Egyptian billionaire has got 2/3 of his net worth in gold. He's worth $5 billion. He's got 2/3 of his net worth in gold. So, and the Chinese, listen, the Russians are the 5th largest gold holders in the world today. So they're not the 5th largest economy, right? By a long shot. They're way bigger gold holder proportional to their economy than anybody else probably, and they're continuing to buy gold every month. China is buying massive quantities of gold. So the gold story and all this injection of money, which really wasn't much brought up yesterday by the Fed. I would say we're in a pretty fragile kind of a mode here. Obviously, if the market did have a mini crash here, it would certainly shake people up. And the problem with crashes is they're hard to come back from, to rebound from. They do a lot of technical damage, and they tend to keep going if things don't improve. So what's happening today should not be. Listen, I wouldn't be holding any industrial stocks today. I mean, anyway, if I was a fund manager, I'd be out of all stocks right now. It's just not worth the risk until we get a clearer picture of what's going to happen in the future. And I would have been selling yesterday, not today. Or just like I said, I'm pretty much selling an all-time high, and because nobody knows for sure how, what's around the corner. Listen, if they did alter, this transcript thing, if they did leave some stuff out, that's a kind of a little bit of a, I think it's an uneasy or just a troubling development if that's true. It's just, and I'm really a little bit. I mean, after getting through the Mueller thing to sort of be like a bull in a China ship, and I mean, Trump going after Joe Biden, what the hell is he scared of? He's got the election wrapped up. Probably, targeting him and sort of starting a dialogue with him has actually it probably improved Joe's ratings, and maybe his has brought a lot more attention to him. Most people didn't even know who he was. So
John, I'm going to have to jump off here.
You see Jesse Waters, with his interviews, and he shows people Joe Biden. The guy's been vice president for 8 years, and people don't even know who he is.
Right.
It's incredible. But I think this sort of overzealousness, and especially with all, I mean, why give anybody an inch to have a go at you? I mean, look, they're bringing, the reason why Hillary brought up Tulsi Gabbard, called her a Russian asset, is she's trying to set the stage to blame Russia for the next election loss. It's such a scam. It's just crazy. I mean, I'm telling you, we're probably going to know the truth sooner or later with all these investigations and books being written, but at the end of the day, Trump's probably going to be vindicated, because it'll be proven that these people who were indicted, remember this was I don't know whether they got the numbers out of the phone book or out of the Russian military manual where there's some names and addresses, and they indicted a dozen people, just to strengthen their case against Russia. I mean, actually, I don't know whether there's any recourse on Mueller for some of the stuff that they got up to, including that lead prosecutor, who's really a real rogue, and allegedly. And so there could be an awful lot of stuff comes out in the next few months that could have all kinds of implications for markets.
I agree. Yep, it's going to be an interesting year to come.
Okay, listen, thanks again
for
thank
you, John.
Invite. Yep, all the best. Have a great afternoon.
Have a great afternoon.
Bye.
Okay, guys, we're way past time, and I got to run. So we'll pick up where we left off today. Tomorrow we'll do 2 days worth of recaps and all that. Thanks so much for tuning in. Whoever you are, wherever you are, May God continue to richly bless you with His mercy and with His grace. And I'll see you at the bell.
Remember this, there is no greater return on investment than to see a human life changed and given hope. As always, pray hard and trade safe. Any financial information discussed on this show is simply the opinion of our host, Dwayne Reeves, his co-hosts, and guests. To learn more about trading Emini Futures or to take a 1-week free trial in our live trading room, call 1-866-928-3310. 866-928-3310. Information discussed on this radio program should not be construed as a recommendation to buy or sell any security. Always do your own due diligence and consult with a licensed securities broker or financial planner before making any investment decision.